One day, March 10th, 2023, Silicon Valley Bank collapsed in 36 hours. $209 billion in assets evaporated. The 16th largest bank in America gone before most people finished their morning coffee. But here's what the headlines didn't tell you. SVB wasn't an outlier. It was a warning shot in a $5 trillion crisis that's been building systematically since 2008, hidden in plain sight on bank balance sheets across America. In the next 18 minutes, you'll see the exact mathematical mechanism that's currently destroying regional banks, why the Fed can't stop it, and why this collapse follows the same pattern that wiped out 9,000 American banks between 1930 and 1933. This is not theory. This is documented Treasury data, FDIC filings, and Federal Reserve balance sheets you can verify yourself. The regional banking system is sitting on $620 billion in unrealized losses right now, today. And what happens when depositors realize their money isn't safe is something even regulators refuse to discuss publicly. Listen closely, because every number you're about to hear marks a moment where the system moves closer to collapse. Let me show you something that once you see it, you can't unsee it. Banking collapses follow a pattern, not a vague pattern. A mathematical certainty so precise you can time it with a calendar. It starts with artificially low interest rates that force banks into a desperate search for yield. Then comes the asset bubble as banks pile into safe long-term bonds and securities. But here's where it turns deadly. When rates rise, those safe assets become anchors. Mark-to-market losses appear overnight. Banks hold assets worth less than what depositors think they have. Then depositors notice. The smart money moves first, quietly, then comes the panic. Bank runs accelerate faster than regulators can respond. And finally, the consolidation. Big banks absorb failed banks at pennies on the dollar. The same wealth transfer that's happened in every banking crisis for 200 years. This pattern destroyed 4,000 banks during the savings and loan crisis in the 1980s. It wiped out 9,000 banks during the Great Depression. And it's unfolding right now in 2026, exactly as predicted. Here's the mechanism nobody's explaining clearly. When the Federal Reserve held interest rates at 0.25% from 2008 to 2015, then near zero again from 2020 to 2022, banks had a problem. They're legally required to hold safe assets as reserves. But safe assets, U.S. Treasury bonds, mortgage-backed securities, paid almost nothing. So banks did what they always do. They reached for yield. They bought long-term bonds, 10-year treasuries, 30-year mortgage-backed securities, assets that paid 1.5%, maybe 2.5% if you were lucky. Those assets sat on bank balance sheets valued at face value. A $100 million bond portfolio was worth $100 million. Everyone was happy. Then March 2022 arrived. The Federal Reserve started the fastest rate hiking cycle in 40 years, 0.25% to 5.5% in just 18 months. And here's the mathematical certainty nobody wanted to acknowledge. When interest rates rise, bond prices fall. It's inverse, absolute. A 10-year Treasury bond paying 1.5% becomes worthless when new bonds pay 5%. Nobody wants your 1.5% bond when they can get 5% risk-free. Well, the bond's market value collapses. But banks don't have to mark these losses on their books unless they sell. It's called held-to-maturity accounting. The FDIC and Federal Reserve let banks pretend those bonds are still worth face value as long as they don't sell them. It's $100 million in bonds that are actually worth $70 million in the open market can still be listed as $100 million assets until depositors want their money back. Then the bank has to sell those bonds at a loss to get cash. And suddenly, everyone realizes the bank doesn't have enough assets to cover deposits. That's exactly what killed Silicon Valley Bank. Let me show you how this pattern has played out before, because history is screaming at us right now. 1980s, the savings and loan crisis. Same pattern, different decade. The S&Ls dominated American banking through the 1970s. 4,000 institutions holding $600 billion in deposits, financing 40% of America's home mortgages. They were considered absolutely safe, government insured, regulated, too stable to fail. But they were sitting on a time bomb nobody saw coming. It started with the interest rate environment. Throughout the 1970s, S&Ls were locked into long-term mortgages paying 6 to 8% interest. They funded these with short-term deposits. The model worked perfectly as long as interest rates stayed stable. Then Paul Volcker became Fed chairman in 1979. Inflation was destroying the dollar. Volcker's solution: crush inflation with interest rates. He raised the federal funds rate from 11% to 20% in just 18 months. Suddenly, S&Ls were paying 15% interest on deposits while collecting 7% on mortgages. Negative spreads. Every dollar they held lost money. But here's the critical detail. The mortgages on their books, those long-term assets paying 6 to 8%, were now worth a fraction of face value in the market. Mark to market, S&Ls across America were insolvent by 1982. But regulators let them continue operating using regulatory accounting principles that hid the losses. The zombies kept walking. Then came deregulation in 1982. Congress let S&Ls make riskier investments to try to grow out of the problem. They piled into commercial real estate, junk bonds, high-risk development loans. The Garn-St. Germain Act effectively gave dying institutions a casino license. For 6 years, S&Ls gambled with insured deposits, hiding insolvency behind accounting tricks. The collapse came systematically. 1986. Oil prices crashed, taking Texas and Oklahoma real estate with it. Hundreds of S&Ls in the Southwest failed simultaneously. 1988. Commercial real estate nationwide started declining. The losses couldn't be hidden anymore. 1989. The government created the Resolution Trust Corporation to liquidate failed S&Ls. By 1995, 1,043 S&Ls had failed. Another 2,900 were forcibly consolidated. The final taxpayer cost? $132 billion in 1995 dollars, $284 billion adjusted for inflation. Check. Verified. But here's what matters. The pattern of wealth transfer. When S&Ls failed, who bought the assets? JP Morgan, Bank of America, Wells Fargo. Big banks that had stayed conservative absorbed regional competitors for pennies on the dollar. Deposits transferred to major banks. Market share concentrated. By 2000, the top 4 banks controlled 35% of U.S. deposits. Before the crisis, the top 4 controlled 15%. Same pattern, same outcome. And it's happening again right now. 1930, 1933, the Great Depression bank failures. The perfect historical parallel. In 1929, America had 25,000 banks. Most were small, regional, holding local deposits and making local loans. The system was decentralized, community-focused, and completely fragile. Because these banks had made the same mistake S&Ls would make 50 years later. They held long-term assets funded by short-term deposits. Throughout the 1920s, banks piled into real estate loans, agricultural mortgages, and stock market margin loans. Asset prices kept rising. Everything looked safe. Then, October 1929, the stock market crashed. November 1929, real estate prices started declining. December 1929, agricultural prices collapsed as Europe recovered from World War I and stopped importing American grain. Banks were suddenly holding loans against assets worth 30-50% less than the loan amounts. A farmer with a $10,000 mortgage on land now worth $5,000. A businessman with a $50,000 loan collateralized by stocks now worth $15,000. Default rates exploded. Banks started failing in November 1929, but the real crisis came from the deposit side. When a bank failed, depositors at other banks panicked. They withdrew cash, not because their bank was insolvent, but because they feared it might be next. Bank runs became self-fulfilling prophecies. A healthy bank could be destroyed in 48 hours by depositors demanding cash simultaneously. The Federal Reserve, which existed to prevent exactly this scenario, did nothing. They watched the system burn. From 1930 to 1933, 9,000 banks failed. $2.5 billion in deposits evaporated. $43 billion in today's dollars. But that understates the impact. In 1933, $2.5 billion represented 20% of America's GDP. The equivalent today would be $55 trillion. And just like the S&L crisis, the wealth transferred systematically. Large New York banks, JP Morgan, Chase National Bank, Guarantee Trust, absorbed failed regional banks. Deposits consolidated. Market share concentrated. By 1935, the top 100 banks controlled 60% of U.S. deposits. Before the crisis, they controlled 45%. The pattern doesn't change. It just repeats with different names and decades. Stage 1 complete, Stage 2 complete, same asset bubble, same rate shock. Same hidden insolvency, same regulatory denial, same consolidation. Now, let's apply this pattern to today, because every single stage is present right now in 2026. We're watching it unfold in real time with mathematical precision. Start with the setup. Zero interest rate policy from 2008 to 2015, then 2020 to 2022. During this period, regional and mid-sized banks bought $3.2 trillion in long-term securities and mortgage-backed bonds. Average yield, 2.1%. Average duration, 8.4 years. This is documented in Federal Reserve financial accounts data you can verify yourself. Banks had no choice. They needed yield, and these were the only safe assets available. Then, March 2022, the Fed started hiking. By July 2023, rates hit 5.5%. And those $3.2 trillion in securities lost value instantly. A 10-year Treasury bond paying 1.5%, purchased in 2021, lost 35% of its market value by March 2023. A 30-year mortgage-backed security paying 2.3%, lost 42% of its value. mark-to-market, regional banks were sitting on catastrophic unrealized losses. The FDIC's own data from Q3 2025 shows $620 billion in unrealized losses on bank balance sheets. That's not a projection. That's actual reported losses that banks haven't realized yet because they're using held-to-maturity accounting. $620 billion in assets that are worth less than depositors think they're owed. Silicon Valley Bank proved the mechanism works exactly as history predicts. SVB held $117 billion in securities as of December 2022. Paid average yield 1.63%. When rates hit a 5%, those securities lost $16 billion in market value. SVB reported the losses in their annual filing, buried on page 67. Most depositors didn't notice, but venture capital firms did. On March 8, 2023, Peter Thiel's Founders Fund advised portfolio companies to withdraw deposits. Other VCs followed. Within 24 hours, $42 billion in withdrawal requests hit SVB. The bank had to sell securities at a loss to meet withdrawals. They realized $1.8 billion in losses selling bonds. The losses appeared on the balance sheet. More depositors panicked. By March 10th, $42 billion had fled. The bank failed. FDIC seized control. 3 days later, Signature Bank collapsed. $110 billion in assets gone. Same mechanism. Unrealized losses, depositor panic, forced asset sales, death spiral. 2 weeks later, First Republic Bank started bleeding deposits. $30 billion fled in 1 week. Regulators arranged a JP Morgan takeover in May 2023. 3 major bank failures in 60 days. Combined assets, $548 billion. The largest bank failures since Washington Mutual in 2008. But here's what the pattern tells us. Those weren't isolated events. They were stage 3 behavior. The canaries in the coal mine. Let me show you exactly where we are in the cycle right now. As of January 2026, regional banks are still sitting on $620 billion in unrealized losses. The FDIC reports 63 banks on their problem bank list. Banks showing weakness that could lead to failure. That's up from 44 in January 2024. The number is accelerating. But the real pressure is building on the liability side. Commercial real estate. Regional banks hold $2.1 trillion in CRE loans, 42% of all commercial real estate debt in America. And CRE is collapsing right now. Office vacancy rates hit 19.2% nationally in Q4 2025, according to Moody's Analytics. That's a 30-year high. Office property values have declined 28% since their 2022 peak. Regional banks are holding loans against buildings worth 30% less than the mortgages. Default rates are spiking. CRE loan delinquencies hit 7.8% in Q4 2025, the highest since 2010. When those loans default, banks take losses. When losses exceed capital reserves, banks fail. This is stage 4, asset deterioration meeting hidden insolvency. The pattern tells us what comes next. Depositor awareness, then capital flight, then failures accelerate. And it's already starting. Deposits at small banks declined $304 billion in 2025, according to Federal Reserve data. That money moved to big banks and money market funds. Depositors are quietly moving money to institutions they perceive as safer. The smart money is already repositioning. Now I know what you're thinking, but we have FDIC insurance now. We learned from the Great Depression. Deposits are protected up to $250,000. The system can't collapse like 1933. That's exactly what depositors thought in 2023 before SVB collapsed. Here's the reality. FDIC insurance works perfectly for isolated failures. One bank fails, FDIC steps in, depositors get paid, everyone moves on. But the FDIC's Deposit Insurance Fund holds $129 billion as of Q3 2025. That covers 1.15% of insured deposits. If multiple large banks fail simultaneously, that fund evaporates in days. During SVB and Signature Bank, the FDIC had to invoke systemic risk exception to protect all deposits, not just insured amounts. They couldn't let uninsured depositors lose money because it would trigger runs on every regional bank. So they protected everyone. But that cost the DIF $22.5 billion. 2 bank failures consumed 17% of the fund. Now imagine 20 banks failing, or 50. The FDIC can technically borrow from the Treasury, but that becomes a taxpayer bailout, which is politically toxic, which means regulators will resist until it's too late. Which is exactly what happened in 2008 when they let Lehman Brothers fail and nearly destroyed the entire financial system. The systemic risk isn't theoretical, it's mathematical. When banks hold $620 billion in unrealized losses and $2.1 trillion in deteriorating CRE loans, the capital buffer is razor thin. Any shock, a recession, an international crisis, a large bank failure, triggers the cascade. But the Fed can cut rates and solve this problem. Can they? Let's examine that claim with historical evidence. The Fed is trapped in the exact same position they were in 1979. If they cut rates aggressively, they risk reigniting inflation. Core CPI is still running 3.2% as of December 2025. The Fed's target is 2%. They're not hitting it. If they cut rates to save banks, inflation accelerates and they lose all credibility. The dollar weakens. Foreign central banks start dumping treasuries. Long-term rates rise anyway, making the banking problem worse. But if they keep rates high, banks continue bleeding. Unrealized losses remain. CRE keeps deteriorating. Regional banks keep failing. Either path leads to crisis. This is the exact trap Paul Volcker faced in 1980. He chose to break inflation and let S&Ls burn. The pattern suggests Powell will make the same choice. But technology and modern risk management make this time different. No, technology accelerates the pattern. It doesn't prevent it. SVB collapsed in 36 hours because depositors could transfer millions with phone apps. In 1933, bank runs took weeks. People had to physically go to banks and withdraw cash. Digital banking means modern bank runs happen at light speed. Risk management models failed to predict SVB, Signature, or First Republic because the models assumed historical correlations that broke down when rates rose faster than any time since 1980. The pattern doesn't care about technology. It's not a bug in the system, it's the system. The mathematics are absolute. Banks borrowed short and lent long. Rates rose, asset values fell, unrealized losses appeared. Depositors are noticing. The smart money is moving. Failures are accelerating. We're in stage 4, entering stage 5. History tells us exactly what stage 5 looks like. Based on the pattern from 1930, 1933, and 1986, 1995, stage 5 involves accelerating failures and forced consolidation. Here's the timeline projected from historical averages. Months 0 to 6 from today, 10 to 15 regional banks fail. Combined assets, 600 billion FDIC arranges emergency acquisitions by large banks. JP Morgan, Bank of America, Wells Fargo absorb failed competitors. Media calls it stabilization. Pattern calls it wealth transfer. Months 6 to 18. CRE losses force another wave. 30-40 additional banks fail or merge. The problem bank list expands to 200-plus institutions. Depositors at healthy regional banks start moving money preemptively. Self-fulfilling prophecy accelerates the cycle. Months 18-36. The crisis reaches mid-sized banks. Institutions with $50, $100 billion in assets start showing stress. By this point, $203 trillion in deposits have migrated to the top 10 banks. Regional banking is effectively dead. What remains are branch networks owned by JP Morgan, Bank of America, Citi, and Wells Fargo. Final outcome, market share concentration matching 1933 and 1995 patterns. Top 10 banks control 75% plus of U.S. deposits. Regional banks exist in name only, operating as subsidiaries of major institutions. The decentralized banking system dies. Power consolidates. This isn't speculation. This is pattern completion. The mechanism is already proven. The assets are already impaired. The depositor psychology is already shifting. The only question is timing and scale. Watch for these specific signals that stage 5 is accelerating. Signal 1, FDIC problem bank list exceeds 100 institutions, currently at 63. When it crosses 100, the crisis is systemic, not isolated. Signal 2, deposit flight from regional banks exceeds $500 billion annually. We hit $304 billion in 2025. Acceleration means awareness is spreading. Signal 3, CRE loan delinquencies crossed 10%, currently at 7.8%. Above 10%, banks must realize losses at scale. Capital reserves deteriorate. Failures cascade. Signal 4, Fed pivots to emergency rate cuts despite inflation. If Powell cuts 100-plus basis points in a single meeting, it means the banking crisis is existential. They're choosing banks over price stability. Signal 5, FDIC announces systemic risk exception for a third bank. 1 exception is rare. 2 is concerning. 3 means the fund is empty and every failure becomes a bailout debate. These signals are measurable, trackable. You don't need insider information. Just watch FDIC reports, Federal Reserve data, and commercial real estate delinquency rates. The pattern telegraphs itself. So what does this mean for you, specifically, right now? You have 2 types of exposure, direct and indirect. Direct exposure is your money in banks. If you have more than $250,000 in a single institution, anything above that is uninsured. If your bank fails and the FDIC doesn't invoke systemic risk exception, indirect exposure is your investments. Regional bank stocks are obvious casualties, but the second order effects matter more. Commercial real estate values, REIT dividends, pension funds with CRE exposure, bond funds holding bank debt. These assets correlate with bank health. When banks fail, these assets lose value. Here's the strategic framework based on how wealth survived 1933 and 1995. First, Diversify bank deposits across institutions. Don't keep everything at one regional bank, no matter how long you've banked there. Spread deposits to keep balances under $250,000 per institution. Inconvenient? Yes. Safer? Absolutely. Second, allocate to the surviving institutions. History is clear. JP Morgan, Bank of America, Citi, Wells Fargo survive and benefit from every banking crisis. They're too big to fail, explicitly guaranteed by government. Their deposits are effectively sovereign risk. If you're holding significant cash, hold it where government protection is absolute. Third, avoid regional bank equity entirely. Bank stocks are options on survival. When a bank's capital is 8% of assets and they're sitting on unrealized losses of 10%, equity goes to zero. SVB shareholders lost everything. First Republic shareholders lost everything. Don't try to catch the falling knife. Fourth, understand CRE exposure in your portfolio. If you own REITs, check their property mix. Office REITs are disasters waiting to happen. Industrial and residential might survive. Retail is mixed. Know what you own. Most investors don't. Fifth, recognize the concentration trade. Big banks absorbing small banks means their market share grows. Their deposits grow. Their net interest margins improve as competition dies. JP Morgan's stock outperformed the S&P 500 by 47% during the S&L crisis. Bank of America gained 128% from 1991 to 1995, while regional banks collapsed. The survivors don't just survive, they dominate. Sixth, watch the Treasury market. When banking crises hit, money floods to safety. 10-year Treasury yields drop as investors panic. That happened in March 2023 when SVB failed. Yields fell from 4.1% to 3.4% in 2 weeks. If you see yields plunging, it means institutional investors are fleeing risk. That's your signal to get defensive. Seventh, understand the political dimension. Banking crises become bailouts. Bailouts become political battles. In 2008, TARP passed after the stock market collapsed 777 points in a single day. Voters hated it, but politicians had no choice. Expect the same drama, expect too big to fail debates, expect anger, but ultimately expect bailouts, because the alternative is systemic collapse. The pattern gives you asymmetric information. Most people won't understand what's happening until their bank fails or their investments collapse. You're watching the pressure build in real time. You can see stage 4 clearly. You can prepare for stage 5. The question isn't whether this pattern unfolds. History says it's inevitable. The question is whether you position ahead of it or get caught in it. 3 banking crises, 100 years, same pattern, same outcome. We're in stage 4. The unrealized losses are documented. The CRE deterioration is measurable. The deposit flight is accelerating. Regional banks are zombies walking. The consolidation has already begun. You have 2 choices. Position with the survivors and watch the wealth transfer happen, or trust the system and hope this time is different. But remember, this time is never different. The pattern is mathematical. The outcome is written. Tell me in the comments, which regional banks do you think fail next? Are you moving deposits to big banks? What are you seeing in commercial real estate in your city? Subscribe, because the next video reveals exactly which assets outperformed during banking crises, not theory. Documented returns from 1933, 1995, and 2008. I'll show you the 3 specific positions that generated positive returns, while everything else collapsed. And I'll walk through the Treasury market mechanics that create the opportunities most investors miss entirely. You cannot miss this. The pattern doesn't need your belief. It doesn't wait for permission. It just unfolds. Thanks for watching.